fire now is closing in. Nothing to bear and nothing to win. Nothing to win. Could you believe? Could you believe? Could you believe? Could you believe? Fire, take my hand, I'll take you higher than you've ever been, than you've ever been.
Oh yeah Thank you for coming on into the live and sharing your essence with me in this eternal moment of which we all share an inextricable part. Thank you for doing your part, for coming on in and seeing what's up. It looks like Bitcoin took a little bit of a dumparoo over the Friday. Run for Profit Friday was to the downside. It's kind of interesting when you just take off all these indicators and look at price action trapped within these channels of these Fibonacci ABC patterns. It's been recently my thing. It's just a little bit of mean reversion, you know. The red is the mean, is going back to the mean and then bouncing back up to the golden pocket, coming back down and bouncing around in these channels. I was saying it's either going to go to 25 or 22. You had liquidity pools to look at, so let's go ahead and do that. Let's not waste your time. I was dealing with some funeral stuff for the last 2 days. It's nice to kind of, you know, relax in front of the charts. Let's do it together. Today's actually my birthday. I'm 833 years old. I was turned into a vampire during the King Edward, I believe it was. My memories don't serve me as much, but yes, that's why I'm so fair-skinned, you know. I just can't resist. So anyway, as we see here, you have an imbalance of 15 billion to shorts now. That's a lot of liquidity up above. We can zoom in. This is a 1 minute time frame heat map, so the imbalance is only within the candle start here from back here in February 20th to this current moment, 5 days worth of data. So this 15 billion imbalance doesn't necessarily mean it will go up to this zone, but it's highly likely based off the past of what I've seen. We could zoom in here and see what it looks like. So you got 165 billion up here at, looks like 2372. That looks like a juicy chunk right there because it's stacked with all these little bubbles. 121, 69 million. This is high block capital. If you don't know what it is, it shows you the liquidation points. So these shorts are in profit. If they don't close their trade, it's highly likely it comes up and stops them out and grabs all their money. They actually opened it down here where the bubble is open. So you can see that the bubble has them open right here, and so their liquidation point happens to be above that because they're shorts, obviously. So this bounced off here, it grabbed all the liquidity of the longs here, and then it bounced off that liquidity, came up and grabbed the short liquidity off the V-shaped recovery, grabbed that 165 million, bounced back down, grabbed some 60, 100 million here, 100 million there, then stabilizing right now. So right now you're resting on these little lines here to the right that show you some other pools of liquidity here, 70, 160, but highly likely with these big bubbles here, it wants to come back to at least this region on the 1 minute time frame. Now we can go coincide this with the heat map here. So we're going to take a look at the heat map. If it'll load for me, please. Alright, so this is the 12-hour time frame, so it's basically going back to the 24th. It's only a day's worth of liquidity here. So they went down, we can zoom in here too. They went down, grabbed the liquidity grab here. I don't like the 12 hours much. Let's go to the 7-day. Let's not waste your time with this. So here was the juiciness. So you had 3 billion, 2 billion, 2 billion, 3 billion, 1 billion, 1.7 billion, 2 billion, 2 billion, 1 billion. It just went and grabbed all these billions of dollars of longs down here. But now you have this high imbalance up here to the upside at 24.75, back up at the 25K region, a bunch of billions up here. Although you still have a bunch of pools just below here. Let's go zoom in and see what we have. We got 4 billion at 22.3, 3 billion just beneath that at 22.2, 3 billion, 2.5 billion, 2.6 billion, 2 billion. Just this entire range looks hot to take, and it's just within the current scope of things. So they could go back down, do one more liquidity grab before they potentially bounce on the 7-day time frame. So you have to juxtapose these because the pools differ as you change the time frame. So it's kind of like you have to take different puzzle pieces and look at them from different angles to try to see where the pools lie. So you got another pool down here, 20 billion, down at 21k, and all the way down you have these billions, 10 billions paving the way down with the kind of sparse liquidity that was just taken out here now. So the bias seems to be favoring this liquidity pool down here at this current moment in time on this time frame. And we can go to even higher. We're just going to get a little scope of the picture here. So we got 43 billion. Yeah, this whole region looks thick now. You got 30 billion, 24 billion, 23 billion, 20 billion, 23 billion, 30 billion, 32 billion, 40 billion, 30 billion. Like this whole thick region looks like it's juicy to come down to now at this time. It used to be they were aiming at this, but they got what they came for. They got these 40 billion out of the picture. They got this 40 billion out now too. 6-month time frame. Let's take a look. Just with anything, when the shorts close out their trades, they're going to see some profits and see the short close bounce, which recovers this. This one you're not going to see so much here. Yeah. This was what was concerning me on the yearly time frame, why the rally is not necessarily over, because you have 162 billion up there, 100 billion, 100 billion, 100 billion. You have a bunch of shorts still up here in this range that they can come back for. I'm guessing that they're going down to grab the liquidity down below. Currently it looks like our winner for the time frames of juiciness is on the 1 month or the 3-month time frame. Yeah, the 1 month here. So you got this thick band here. So let's go take a look at the charts and see where that puts us. So the full mean reversion of this impulse that took us to the upside, boom, we got rejected at the 706 of this impulse. We started to come back down from that 706 wickage up here, and then you could take the other AB wave out of here. Just look at naked price action with this thing on. So you had, we wicked up to the 6.5, and we've just been chilling. We went down, we got rejected out of the golden pocket here, and we came down to the 382, and now we're coming back down to this. Okay, so let's start to throw on some Momentum Master here. So you're at the bottom of the Keltner channels. What are the Keltner channels? There are these outer bands here based off ATR, and it shows you the average true range. Obviously when it reaches the top, it starts to go back down, and it starts to go ping pong between these channels. They're more accurate than Bollinger Bands, so when you see yourself coming out of the channels, you're going to come back into the channel at some stage. So let's just get out of this really quick, get to a regular price action here. So we're at the bottom of the channels. For all intents and purposes, we should see some gravitation up, at least to the adaptive moving average and the 200 weighted moving average here on the 4-hour time frame. Now if we switch to the Momentum Master B, yeah, we got the low Williams here, and we have the stochastic RSI and the money flow and the RSI all reaching this green zone for getting oversold. So that means we should see some sort of nice double bottom action occurring at some stage soon, if all things considered. That pool, like not looking at the pools that we just talked about with the juiciness that exists below. And this would explain why maybe the hourly is coming down and we're trying to make a lower low, because we're trying to tap into that liquidity pool as we saw on here. So we could be trying to tap into these liquidity pools, because that's 4 billion down there, 8 billion, 13 billion. So you got 13 billion just out of range. Now let's go look at how you can figure out without high block. How do you basically figure out where these liquidity pools are? You've probably seen me do stuff like this where I post like a thing and it bounces off that thing, and why does that range happen to be the place where it bounces? Well, there's something called a fair value gap. And how do you find the fair value gap? Well, you find where it hasn't been trading fairly, in the sense that it just goes in one direction without going the opposite direction. So before we lose our place in time, we're going to switch to regular candles now, and we're going to go back here. It conveniently draws them for me, but yeah, this 1 hour candle, for example. Now, on this 1 hour candle, this entire region is a fair value gap. This means that it just went up without retracing back in any way, shape, or form. So there's a lot of open trades there. So even if you don't have, high block, you could assume that from 23,342 to 24K, there's a large amount of liquidity still sitting there. And sure enough, it is. So you go to a lower time frame and see that's not always the case. Like, it did have moments where it stopped, so this was traded fairly. So realistically, you could move that there, and we already kind of bounced off that. So if we go back to the current moment in time, we already ate that liquidity. So that fair value gap was just chewed right through. But you see how we bounced off it at this point, and we bounced off it again. So those would have been places where you could have limit ordered in before it failed and went through. So now we're looking at places below this line. So we're looking at liquidity zones in this region. So we got to look for fair value gaps. So here's one here. Here, and then we can go to lower time frames. So first, we got to go back to the replay so it doesn't kick me out. Get more precise, you know what I mean? Precision. That one was recovered, but not this one. And you can just like label these two, like whatever. So does that coincide with what it's showing? 22,669. Let's see. 22,669. Yeah, that's not that far away, and it's like $10 billion right there, just chilling. And the entire way looks like it's caked with liquidity on the way down too. Could be seeing a large pullback here in general, just ignoring the ultimate without putting the ultimate on. Now, at some stage we're going to see some sort of bounce, the 100x. So what they do is they knock out the 100x, like they've knocked out here. All these orange guys are 100x people, and now they're going to come back and get these 100x people because they don't want to pay these guys on a journey down to here. So they come up and knock those guys out and then come back down as they accumulate more 100x here. And it's just a constant swatting of 100x traders off the chart. Sorry, this should show statistics. Alright, so we should be seeing a bounce here just off of the fact that they cleared the 100x and now they can make their way to grab the 100x up here. So let's just turn the liquidation levels off here and switch to a lower time frame. Ranier was going over on his live stream about the crossovers, these crossover events of these leading averages, moving averages. So here's where I switched to the Heikin Ashi to get precise. Shout out to Peyton and Smurf for using the Heikin Ashi for this. But you basically would find these crossover events. We already back tested this leading moving average formula, and basically when you get these beneath the candle close and then you get a birthday candle hammer here, then you're going to see upside at least until it crosses again. So you could have basically entered off of that and then still been up like 0.15 and then just be riding it to see if when it fades. And based off of how the cloud is thick here, you're getting this thick cloud which is volume based in nature. So it's showing that there's a selling pressure, a resistance here that's potentially knocking the price down off of this cloud. If it doesn't make it through this. And so you can look at, you got some bearish divergence that started to play out, and then we're trying to get back up, bearish retest back down again, perhaps. Let's go to a 1 minute real quick. So you could have just taken this 1 minute, and this is what these guys in the Momentum Master Discord are getting really good at, is just scalping and just taking, you know, 0.5% here and 0.5% there in and out of the market and watching it cascade to higher time frames. So you'd watch how this cascades to higher time frames potentially, because you're on the bottom of the Keltner channel, you're kissing the baseline, although you're getting the thick price cloud, the trend cloud, but you could surge right through at this moment to at least grab the short liquidity that's the 100xers up above. And then you got to do it on both sides when you do the fair value gap, so you got to look at the gaps that you would recover. All right, so here does it for you, so you got one gap here. This one was already recovered. You see this wick? So this one, they already recovered that gap. See, they went and recovered this gap and then continued down. So they didn't have the energy to muster together to get this gap just yet, but they could have gotten enough liquidity off of the drops here to go up to this fair value gap. So that's also on the table. And then you have these, they're kind of like magnets that gravitate the price up. So they went and recovered this gap, and then they continued back down. This one still yet to be recovered. So 23,456, let's see what that is. Let's go back to this. We got to go to a different time frame. Let's go to the 7-day. There we go. 23,456. It's $1 billion up there. There's 2 billion. There's $2 billion just in that vicinity. So that fair value gap is true. There's like $2 or $3 billion there. So they might go knock that out before they go back to this pool. So this would just be a scalp that takes you up to this region, and then you could possibly look for a short entry to go take this pool out too. But you always keep in mind the pools and mind your stop loss and all that stuff, and see the disclaimer above, because this is all for entertainment purposes only. But you are getting these kind of double bottom vibes, at least for a small region up, small bounce to some region, at least to kiss something, knock out the 100xers. See these 100x people, they don't want to pay them, so they take out these 100x longs, and then they take out the 100x shorts, and then they possibly come back down and take out these guys. All right, so let's look at the grander narrative here, stochastically speaking. Some of you are stochastic traders if you've come from my predecessor, who's stochastic RSI trader. So the Momentum Master basically factors 7+ time frames of data all at once to give you a symbol boiled down into a coalesced thing. So let's go ahead and look at what it's saying. So first of all, we're going to just go back to higher time frames first, the daily, and just look at everything fresh. So on the daily time frame, you have this thick volume-based moving average trend cloud that we're kind of breaking through at this moment in time. We're at the bottom of. We wicked off it originally, and then we're kind of at the cusp of breaking beneath it. And still thick though. Still thick. We did meander around here for a little bit, and then I put out the idea of that rounded bottom that took us out of here to the top of the channel again. So you're seeing this arrow is a cumulative volume over the time frames. Think of it as a cumulative time frame volume delta. So it's showing you the time frames of multiple time frames of volume leaving, and the length of the candle is directly proportional to the amount leaving. So here you had a lot of volume leaving, some entering, more leaving, some entering, some leaving, a large amount leaving here. So if you have this large amount leaving here over these time frames, you could have a large you had this large liquidation event. So we look for the 22-hour here. The 22 hours completely reset. The Williams still has room to come down. So in times past, when you had a complete reset but the Williams was high, you had a lot of meandering around. So you could still see more downside, and the liquidity agrees based off of the fact that you're still coming down off of this. You could double top off the Williams here, but this is where stochastic RSI kind of fails, because it only factors sensitivity and can get pressed here. So you need something more, and that's what the Williams is about. So the Williams kind of gives you whether you have more room to go down and get suppressed essentially. So you could see suppression on the 22 here. You're getting rejected on the adaptive moving average. You have higher time frame suppression also potentially kicking in by pushing you down here. So overall, you don't have higher time frames in your favor now in terms of momentum. It's turned against you, but you are seeing a lot of time frames oversold. So you should see at least a cash-in bounce of some kind. We just had the 12-hour close, and the 12-hour close bearish and below the adaptive moving average. So that's getting, and you had this alarm cross telling you potentially to get out of that. And so yeah, we're not above the adaptive. That's very bearish, and you're below the cloud. As of this moment, we could still see more downside. Then we go down to the 6-hour. 6-hour, the Williams is in a spot where it's nice and low. Could curve up here and give you a bounce. You're right at the adaptive on the 6-hour time frame. The adaptive moving average is kind of a sensitive to volatility, but not sensitive to noise moving average, which stays stable among the noise, but then gives you an accurate depiction of where things gravitate back towards, or up towards rather, if you're below it. So we're here at that point at the bottom of the 6-hour. The 6-hour is in a good spot. So I like where the 6-hour is at. The 12-hour is not necessarily finished per se. And you look at the 4-hour too. 4 hours in a good spot, but this is where I used to get in trouble, because I would enter when the 4-hour was low, But the 4 hour is not always your go-to thing. You have to look at where the 4 hour could be potentially suppressed by daily time frames and by basically the 6 and the 8 and 12 hour time frame kind of give you that idea of suppression. So when the 4 hour was low, the 6 hours still had more room on the Williams to come down on you. This is kind of why you had an attempt to go up here met with bearish divergence, because the Williams was already high. So you had the suppression, and the suppression, everything got suppressed down while this Williams reset. So let's go back to the 12 hour to show you that again. So the 12 hours Williams is still coming down, and this is why you haven't taken off even though you're oversold on the stochastic RSI. And so that's what this is referring to, things getting lower, but at the same time you still have room to go lower on the RSI and the Williams. Alright, so with that in mind, let's go to the 1 hour time frame, take a look. So the hour time frame had money flow bearish divergence. So if we look here, from this point up here to this point here, the money flow entered in, but obviously didn't make it to that point before, so that's bearish divergence on the money flow. It's hidden bearish divergence. And then we saw it play out where it dumped further down. And this is where the cumulative volume stuff starts to factor in. You see these arrows kind of showing you the volume leaving, despite it being a green candle. There's sell-off pressure here. So we're getting a severe amount of selling as we go up too. So there's a narrative shift in terms of selling coming down on you. And the Williams is in a good spot, but the hourly just came down. You could bounce off the 50 here and kind of go up from this point and take out those 100xers on a scalp trade. And so as you see here, the baseline starts to come below the price, and then when you start to scoop it underhandedly, when it goes underneath the price, it starts to create these rounded bottoms using that, and that kind of gives you your edge in terms of, like, you don't want to enter here because it's completely away from that. It's no end in sight necessarily. You wait for these moving averages to scoop beneath the price very nicely and cross over with the price, and you just ride it up with the crossover. So let's go ahead and take a look. Looks like we're about to get that crossover on the 15 minute. Possibly. Everything's a possibility, right? So you had this crossover and then it shot up, and then you could have got out at this crossover. You could have paid yourself nicely there at the rejection of the cloud and the ATR. But here we go. You're kind of getting that potential cross on the 15 minute. And you would have received this alert to your phone on the 5, telling you that we were oversold on 5 time frames here. We're at the bottom of this Keltner channel, and it's possible double bottom, as I pointed out. Where was it? Yeah, I pointed out that it was a potential, double bottom of some sort. And you're getting bullish divergence on the money flow here on the 15 minute. So in terms of a 15 minute scalp, you got bullish divergence on the money flow. You're getting a rising sun on the Williams. This 15 minute scalp could have been your scalp ticket if you watch for this to cross, as we watch for this to cross. Let's look at the 7 minute and so on. I like the 10 minute a lot recently. Yeah, you had bullish divergence front run. crossover here. Just getting a lot of sell-off pressure. A lot of fear entering in right now as the narrative shifts. The 5 minutes getting overbought here, and you still have this thick cloud. So what you normally see in the situation where it would be a healthy scalp above the cloud would be you see it break through the cloud, come back, retest it. So it breaks up, retests, and then goes up from there. What? Sorry, I'm using Brave browser. It's pretty protected. Getting a cross down right now on the 1 minute. Getting that rejection at the weighted moving average. Let's throw on some fibs while we're here. I'm going to turn this off now. I'm going to use a trend-based fib extension tool. I'm not sure if you know how to use those. They're quite nice to predict trend here. So you go to trend-based fib extension. You do a click from the impulse and the retrace. And you got that 706 rejection, dumped it down from there at 23,818. Right there, exactly. So within this drop, retrace had a narrative of a bearish projection zone, which was here. And we bounced into the golden pocket region, which is between the 1 and the 1382, which is here, and that's where we currently reside. But that was prior. If you were looking at this zone here, I put that out, I believe, in the, I said the bearish projection, like below the 236. I was saying if you get below the 236, then you're bearish or whatever, and that was when we were up here. So you could have taken that entry from the 236 here when we bearishly retest here, and then you could have gone down and then seen where we break through there. So let's go see if from this region here we can do the same thing from this to that to here. And that's where we are on the 1. Pretty amazing, right? Fibonacci. Pretty cool. So we broke right through the 706 on that one. And your 236 would have wicked up and filled here, and then you could have gotten that fair value gap fill and then just kind of ridden this down. Now we're down at the 1. So, and this coincides with that fair value gap that I was pointing out. Did I point it out? No, it was here. Yeah, it was at 22,669. Let's do that again. I don't know why it got deleted. 22.2. So the confluence zone is this 706.65 region. So coming up to that at some point and then getting rejected to come down there would be something to look at potentially. And then that also happens to be like 50% of that vector, right? So if we just take this and we go 50%, let's just do the whole impulse. That would be the 0.65 kind of region of that entire impulse to the downside too, like the golden pocket or whatever. So, I mean, they should realistically come and take some of the shorts liquidity. Let's go back and look at the liquidation levels to coincide with that. How y'all doing? Doing good on a Saturday? All right, so we went and grabbed that 34 million, 33 million, 34 million. So that coincides with 23, 4, 5, 6. Let's see. 23, 5, 4. 23, 4, 4, 8. So there's a large amount here, but this is stacked from way back here too. So if I go over here, there's like all of these accumulated 200-300 million here. And right now it's sparse in this region up here to jump from, where are we at, 23k? To jump $300 in price action with no liquidity up here, essentially. Yeah, you could be coming down to grab this little band, this pool here. So you're getting just a few time frames overbought and then they just immediately dump it. So there's no like conviction in a long right now. Everyone's kind of thinking about shorts. And you still have that thick sell-off. Cloud Energy. Although the number of times that I've seen like, you know, 5s and 6s like this where you get this extension and then everyone's ultra bearish and then it shoots up in your face. You know, it just happens sometimes, so it's something to heed, to say the least. Interesting. You're getting like a thinning out on the cloud on the 30-minute. What's that about? All right, so let's go. Let's just take a step back here, turn everything off real quick. So the one thing that we lost that I was talking about before also with the trend-based fib is we had like, so we lost the bullish trend-based fib, so that kind of narrative is finished in terms of losing that, going up to the upside immediately soon. So this just tells you how you can scalp those 236 entry, get out at the 1382. I quite like trend-based fib extension tools. I mean, realistically, it looks like we're ranging on this one, and then people are looking for kind of like bounces to re-enter up in this 65706 region. I still think that 100x, the 100x zone, people. Also, the amount of longs you see enter versus shorts also implies like they're not done screwing with the longs. Oh, one cool tool, let's do that while we're here. This is a liquidation, aggregated exchange liquidation website. Free. It shows you all sorts of time frames down to even the 10-second and how many people get liquidated here. So you can kind of get messages of when people get liquidated. I was looking at this every day for over a year. It's quite fascinating. Let's go to the 10-second here. This is v3.aggr.trade. Definitely a good resource to have open and check. If you're not in front of a computer, they do have like liquidation levels searchable on YouTube, I think. If this will actually load properly. We'll come back to it. But yeah, as you see here, this other one is by ML Applications. You can search liquidation levels version 2. It's a free one. You set your threshold to 0.1, so it'll show every $100,000 trade. And yeah, it'll show you how many of them are in 100x, 50x, 25x positions. And so you can see that there's a lot of longs opening up in this potential double bottom idea here. But that could be a bull trap based off of how many have entered here, and not so many shorts have entered in that same time frame. So I would often use this to scalp an idea about whether that's a genuine bottom or not, based off of how much interest gets triggered here. Now there's a lot of people that use other things to find out open interest and other things. There's more than one way to skin a cat, pardon the pun, but yeah, you can see that there's less shorts here. 1, 2, 3, 4, 5, and then here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So there's clearly more long interest here. But if you get lost in this minutia here without looking at the bigger picture stuff first, you could get stuck in an idea for one side getting gobbled up, and I've seen them leave stuff like this too. So it's just one extra tool to observe. It's a low liquidity weekend. It's highly risky to scalp in the weekend trades. Overall though, in the minutia of things, like seeing some sort of grab up to recover these gaps is not out of the question for those billions at some stage coming up into this region that they just gobbled up all the longs from. It's starting to get sparser here down below compared to how thick it is up here. So even coming up to like these previous high regions over the weekend would not be seeing like a short squeeze of some sort, would not be out of the question at some stage. And let's go over one last concept for today. We're going to go over like premium versus discount. So let's just get out of this mode. We're not going to look at anything else at the moment. We're just focused on Bitcoin today. So premium versus discount. So we saw basically everything trading in this range, right? For like okay, so I mean realistically in the last since January you've been from like this region all the way from the region of from the price of 25,233 down to 21. So basically if you want to look at this as a range, then everything above the 50% level is premium and you don't go long on these premium regions. So you would basically go like this, and anything above 0.5 is premium. It's paying too much for something, so you would not go long above here, and anything below 50% is discount. So you would try to find these discount ranges. So this is what a range trader does when things are consolidating. You would find a point below the 0.5 to long, and then above the 0.5 to sell. And that's how you would establish positions for scalping and so on and so forth. And you could do that even within a scalping range of here, even within a smaller time frame. So you could go to like a 4-hour time frame here. And let's just say you had where would we start? So this was let's just do a week, okay? So last week. So you would take the low from last week and the high from last week. And then you just basically do a Fibonacci retracement from the top to the bottom. And then anything above 0.5 is premium, everything below is discount. And that's why people would take this up, and then at the 706 they sold off, and then they went down. So you can see that 236 down here is green for entering long. You can enter up here. You start to get into the premium level, 706, 786, 886, like that's where you want to start thinking about getting out. So you get out, reach into the golden pocket, go down even quick into 382. You can see that up to here's premium. You don't want to pay for that, you short. You go down here, 236 entry again, it's discount time. You go back up here, you start getting into the premium, and you short it and take it down. So if you're just looking from this high to this low, This simple impulse, this retracement gives you this information here, which you could have played out into the future successfully by looking at these rejections at the 0.65 and you know, trying to find entry for longs down in the discount region and finding areas of shorts in the premium region. 886 would have been a key one. And so you could have just played this range from this last week. And so that's how you use premium and discount. And since we broke the range and now we're trading into a lower range, you use the same tool from here to here. And now we're entering into that region. And we've entered into this is external versus internal liquidity. So we were in an internal liquidity range. Now we're in an external liquidity range. So this external liquidity range discount region is below the 0.5 here. Sorry, let me go in the direction that it went up. Yeah, so ideally you'd want to find it retraced down to here for a discount. For, you know, right where we're at right now, this is a golden pocket region, the 618. It did get a rejection at the 618 exactly, and then bounced up. So you could have basically seen that coming and taken profit there, or bounced off the 618. Jason Casper always talks about 618, but that's one way to do it. And then for a true long, if it was going to be established for a continuation, you'd be looking for this region here. So this is not exactly the best long-term long. You'd be looking for the 706, 786, retrace into those regions for the reversal. And that's about it. So we're just doing a little update stream. It's been a while. I'm a little bit rusty. But once again, thank you for coming on into live, sharing your essence with me in this eternal moment of which we all share an inextricable and inexorable part. So this is the bearish trend-based fib extension projection. You break this, you could come all the way down to here. But you could come up and grab these, recover some of this fair value gap region and then continue down as well. You could come up here and come down to here, or you could just break down completely and come down to here. Chances are, stochastically speaking, you're still keen to go to this region and then establish. Definitely would not short at this point. You would find a long scalp, but even the long is risky at this time. We've entered into the external liquidity range. So once again, the external liquidity range below 0.5. So we are currently at a discount, but not that much of a discount in the external liquidity range, and so it could come much lower for people to start to perceive it at a discount since we broke the range here. Let's turn this back on one last time and say I bid you adieu. So let's see what we're seeing here. Got that. It's a really thick cloud here. It's a lot of pressure, selling pressure to stave off. And you got the higher time frame finger suppression here, a lot of volume leaving. It's not my cup of tea to long personally. Even though the time frame's looking exhausted in terms of oversold. But if you're really itching to get into something, you'd wait for some more 100x to get gobbled up, as we showed you the 100x traders entering in more volume than the shorts here. So they can come grab those guys one last time before they go knock out the 100x guys from up here. So you wait for a liquidity grab. A liquidity grab is when you can bounce off the liquidity of people who've been knocked out. So knowing where the liquidity stands using these type of tools is kind of a good measure to see, because you can see it's imbalanced, right? And then so you can basically guess it's going to go that direction and then bounce off of the liquidity once they knock them out and don't have to pay them. They can use their money to buy Bitcoin, and then they would shoot up to knock out the other guys who are profiting. And that's what causes the price to move. Alright, let's see if this is moving. Alright, there we go. So, this is the v3.aggr.trade finally loading. So you see these little gold things, that's liquidated bulls. The purple is liquidated shorts. So you had 114k 46 seconds ago that got liquidated on Binance. And so we'll see this liquidation occur. This is a 10-second candle. So it's interesting because you can see exactly where they liquidate people and when and on what exchange. And once again, this is 19 exchanges, so they'll tell you if it's like Binance or KuCoin or whatever. And so you'll notice they always bounce off of these liquidation events. So you can time the liquidity pools and liquidation events to some sort of bounce occurring. And with that, that was a short but sweet stream from Illuminated. Nothing. Hope you enjoy your weekends. Remember, trade safe.